Good afternoon, everyone. I am Kathy Neifeld. I'm one of the partners at Agency One, and I am pleased to be bringing you today a webinar on, you can see the screen, creating opportunities to reward and retain key executives using life insurance. When we marketed this, we talked about a guaranteed issue multi-life program. And if I get one request almost daily, it's for a guaranteed issue. And Symetra has stepped up to the plate and created this program. So we are pleased to be able to provide this webinar for you from our friends at Symetra. Our featured speaker today is Doug Bowden, who leads the Advanced Markets Group at Symetra. As the Director of Advanced Markets, he is responsible for the creation and technical support for customized advanced sales solutions, including management of the premium financing and multi-life platform. He has over 30 years of experience in life insurance field, specializing in case consultation and product management. To say that he is beyond qualified would be an understatement. This is one of Symetra's sweet spots. Steve Patrizio, the rep for Agency One, is also on the phone. Most of you know Steve, and you know that he is truly one of our favorites and advocates tirelessly on your behalf. So Stephen, thank you for making Doug available and for helping us to create this webinar. And without further ado, I'm going to turn it over to Doug, but a little housekeeping first. The webinar is going to last approximately 30 minutes. We would ask that you type your questions into the chat or the Q&A, and we will address them at the end. And then Lisa Mitchell is going to have some additional announcements after the webinar is over. So please hang in there with us. And without further ado, I'm going to turn it over to Doug Bowden. Doug, take it away.
All right. Thank you, Kathy, and thank you, everybody, for joining us today. We do appreciate your time and giving us a chance to tell this particular Symetra story, which we're excited about, and seeing lots of opportunities out there. And hopefully, by the time I finish sharing this with you, maybe you'll have some good questions and some good potential opportunities out there to get in this space. So when we look at the reward and retain key executives that's in the title here, we're all kind of familiar with the phrase, right? The 3 R's: reward, retain, recruit in the business marketplace that's in there, and so forth. So really what I want to share with you are some key designs that we're seeing in the marketplace, in the business space, and then it'll roll into the Multilife platform as you'll see it in there. So when we think of the deferred compensation space, there's really 3 levels of complexity, or not really complexity, but designs that are in the space. We think of true deferred compensation arrangements, which are great designs, which could consist of deferrals, true deferrals, employer matches that are set up with key executives. And we can do supplemental executive retirement plans. So the buzzword SERPs get in there, and then we can split dollar the SERP and endorse some death benefit over, and it gets fun and wild and crazy to do that. But there's some heavy administration, and it's kind of unique and nichey and a bit complex in there. In the middle of the space, we have, in our arena where we're seeing activity, is really in the split dollar space. Split dollar is so flexible in that, we're not really looking for immediate tax savings. We're really looking for that handcuff, which is that reward, retain, and possibly recruit section that's in there. And we're more concerned about cost recovery using corporate after-tax dollars to fund a key executive benefit, as opposed to that immediate tax savings, right, that's out there. That's why we would focus on a split dollar arrangement. And we have incredible flexibility with the ownership. It could be owned by the business, an endorsement split dollar arrangement, and the death benefit endorsed over. Could be a loan regime split dollar, where we're talking really each premium payment is a loan, which I'll get into in a little bit. here, and we're concerned about creating that supplemental income along with that death benefit. And then, of course, we have non-equity collateral assignment, which can also be individually owned, like a loan arrangement, or even trust owned for the flexibility. And if we have 5, 10 key executives, we can mix and match whatever that design wants to be is the best fit, right, for those particular executives. That's the beauty of split dollar with the creativity in there. So we tend to see a lot, and it's kind of biased because this is where I come in on case designs, is even though there are many designs out there, which I'm talking about with split dollar, a loan regime split dollar arrangement has tremendous traction in the conversations that I'm having with producers and setting up case designs that are out there. And again, we're not concerned about immediate tax savings. We're really concerned about whether we have the owner of a C Corp, or we have key person in a C Corp, or we have key individuals in a pass-through entity. And we really want to put that handcuff on and supply that death benefit protection in a low-cost atmosphere, right, to do that. So if we just tee this up, we're assuming a C corporation in a 21% tax bracket for this loan regime split dollar. We're assuming it's going to be individually owned for the sake of the hypothetical here. And we're going to assume either the business owner, C Corp owner, or the key individuals in a 37% tax bracket. And I'm using a high tax bracket to make a point because it works great at 30%, 32% for a tax bracket in this example here. So 45-year-old, because I want you to just see the numbers, not, we have a 38-year-old or a 43-year-old in here, and we have odd years. I just want you to see the whole big picture in this hypothetical. 45-year-old male, just preferred risk class. We're going to maximum fund at $100,000 a premium for 10 years, and we're going to use a minimum non-MEC death benefit. Now, of course, in a split dollar arrangement, we could have a specified death benefit that we're looking for the key executive on their side of the equation. But for the sake of this hypothetical, we're just doing a minimum non-MEC. So we're building up a hypothetical cash value. And you can see at the bottom of our screen, we're just using our accumulator Ascent IUL product, and we're using a 5.97% hypothetical illustrated rate in our scenario. So our 10 pay goes in, and the policy, again, individually owned, and we're collaterally assigning the policy back to the business so they have that control. So each year we fund a premium, we create a new loan, not a new loan, but we're doing a demand loan, and we're accumulating the loan into the actual loan each year. So we're going to have a total loan at the end of the 10th year of $1 million in our hypothetical here to do this. And you can see the net surrender value here under the XYZ Corporation. We're going to completely collateralize, again, those premiums. So if there is a termination or individual leaves voluntarily, there's options on what to do, right? So we're fully collateralized by the 7th year in our hypothetical here. So we have $700,000 of cash surrender value collateralized to the business and in that 7th year. And therefore, at this point, if the executive were to terminate or leave, we have controls over what do we want to do with this? Do we want to terminate it and just collect our cost recovery of premiums, which is probably more than likely surrender the policy to do that? Or do we want some other options to keep the policy going forward? So again, we're doing a 10 pay, and we get to the end of the 20th year in a perfect world at age 65, which we all know it doesn't work this way, but again, hypothetical. At the beginning of the 21st year, we're going to assume that the business is going to forgive the outstanding loan arrangement that's in place in here. Now, obviously, there's no promise to pay a future benefit because then we have a 409A deferred compensation arrangement. It's purely a hypothetical of if an employee stays this far, we may forgive the loan arrangement at the end. However, for a 7872 loan arrangement to be effective, there should be every intent to have an above the table loan based on the blended short-term AFR rate using a demand note, and the obviously the ability and the intention to repay the loan, whether it's death, termination, is there, then it makes a legitimate 7872 loan arrangement in here. So again, hypothetically, we're just going to assume that perhaps the loan is going to be forgiven if the key executive or the C corporation owner, gee, what do you think, is going to be forgiven if it's the owner of the C corp in there. And now, again, fully collateralized, and let's get into a little bit of the weeds here. We're just going to assume that the annual loan interest rate for our AFR rate is going to be 5%. Today, I think it's 5.02. It's going to change again coming up here. Actually, they'll probably publish it this month in there. And what that is the short-term blended rate, which is the January rate and the July rate, and they're blended together and they create an annual rate. So we can use it for a demand note each year instead of doing monthly calculations with an AFR rate in there. And we can accumulate the demand note. And so each year that cumulative amount is going to get charged whatever the blended short-term AFR rate is. And the AFR rate goes up, it goes down. Just to put it into perspective for you, 3 years ago, I believe it was 3 years ago, the blended short-term AFR rate was 13 basis points. I could be wrong, could be the fourth year, but about 3 years ago in there. And then just the previous year was 4.64, and now it's 5.03, and it's probably going to come back down again with that January and July blended rate for this year. So that's why I'm using 5% for the hypothetical. Could go up, could go down, but I'm using the higher spectrum for an interest rate. So our first year premium, 100,000, equates to an annual loan of 100,000 to the key individual, and we have loan interest at 5%. So we have a recognition of income for the loan interest of $5,000. They're at a 37% tax bracket. That's 1,850 in the first year. So 1,850 for a death benefit, which is the retained death benefit, meaning the residual death benefit, meaning the corporation gets their 100,000 out of the death benefit in the first year, and then the residual amount, 1.5, is going to the key individual here. So we have 1.5. So competitive with a term product in the early years, but that's not the point of the design, right? Is to, if we were going to do that, we might think of a non-equity collateral assignment, and we might use alternative term rates as the hypothetical, if that's truly what we were trying to do in here. But we're not trying to do that in this example. We're really trying to get to a supplemental income plan or alert strategy, if you will, using corporate after-tax dollars. That's the whole tax leverage that's going on here. 21% tax bracket, putting it in the hands of a 37% tax bracket, using the power of the life insurance policy with the tax-deferred growth inside it, and then having the ability to cost recover at any point in time and individually owned makes it an ideal scenario. So as I go through this, we get to our 21st year. And remember, we said the loan's going to be forgiven. It's hypothetical. It's going to be forgiven. So now we have $1 million bonus. Holy smokes, $1 million bonus from the employer. So now we have tax due of $370,000. So we're going to use policy values as a withdrawal, not a loan out of the policy for this hypothetical, because I want you to see that the math can work within the life insurance policy. So we're doing a withdrawal of $370,000, and we still have $2.2 million of hypothetical cash value in the 21st year here. And we have a $3.6 million death benefit going forward. And we haven't played any games where we're reducing the death benefit down and building up even more cash, because we could do that, right? So this is just your basic design, increasing death benefit for 10 years and then switching to level and then taking a withdrawal. And we have that. So Doug, what is the whole point of the story I'm telling you is that look at our after-tax outlay. If we're assuming they're paying the tax out of pocket, that's due out of pocket. Hypothetically, it was just under $300,000, $286,000. And we take a distribution from the policy, and we have $2.2 million of cash surrender value. So does anybody want to guess what the internal rate of return would be on $286,000 over 20 years to get $2.2 million of potential cash surrender value? It's going to be a really attractive internal rate of return. And again, hypothetical. Even if the policy only earns 5% and it only has maybe 1.5 million of cash after the distribution, that's still pretty attractive return. And in most situations, that after-tax outlay would be covered with some kind of bonus. We could single bonus it, right, from the employer. They would get immediate tax savings for that, and we can reduce that after-tax outlay out of pocket, or it could even be grossed up to make it the ultimate, most attractive scenario that's out there. So loan regime split dollar, we see it a lot. It's great flexibility, and it really can create that LERP or that supplemental income plan strategy, or again, where we're getting that tax leverage of the corporate after-tax dollars into the after-tax of a higher tax bracket that's out there. And we have that individual ownership, which makes it attractive, as opposed to that future promise, which is attractive, right, in a deferred compensation arrangement, but there's nothing there except the promise, right, to pay that, which is great, but you get the idea in here. So based on our hypothetical, if we were doing the 5.97% illustration in a 37% tax bracket, it would have a distribution of 166,000, again, hypothetically, a 20-year income stream, and it equates to 264,000 pre-tax equivalent. Even if the illustration was ran at 5%, which I was kind of mentioning in the other slide, we still have a pre-tax equivalent of just over 200,000 in a 37% tax bracket. So we know the green numbers, right? The after-tax numbers are all going to stay the same based on the hypothetical of the illustration. And then those blue columns are just going to fluctuate based on a tax rate. So if they were a 32% tax bracket, still pretty attractive for that pre-tax equivalent return that's in there. And then, of course, the beauty of the individually owned policy is that you don't have to take a distribution at age 66 in the 21st year of this particular scenario. It's just set up that way. But if there was a wait and see approach, which makes that individually owned policy so much more attractive, right? They could maybe not take a distribution until age 68 or even age 70 because they have cash flow in the early years. And then, of course, if they wait until age 70, based on that 5.97% hypothetical illustration, that pre-tax equivalent would be 365,000 for 20 years. It's amazing. And it could just be a 5-year distribution. It could be a 10-year distribution. It doesn't have to be 20. We're just doing that so you see the numbers that are in there. That's that flexibility. And then on the other side of the spectrum, what we're seeing in the reward and retain arena is we get split dollar arrangements, but then a little lower on the spectrum of complexity, we get into bonus arrangements. We still have that individually owned policy, but the beauty of the bonus arrangement is the employer now gets that immediate tax savings on all the premiums they're contributing to the individually owned life policy in the form of a 162 bonus in here. So we're not concerned about cost recovery. We're just really concerned about maybe making the plan a little more simple and getting that tax savings up front. To us at Symetra, we're here to help. We don't care if it's a split dollar arrangement or a bonus arrangement. We just want to help you get the sale and make sure it's done to what an individual is looking for. So a typical bonus arrangement that we would see is not a single bonus arrangement because those really aren't that attractive, right? If we were going to have a $20,000 annual premium and we were going to single bonus it out in a 32% tax bracket here for a 45-year-old, I changed the tax bracket a little bit and I changed the funding to a 20 pay in this scenario. In here, you can see that if their net after tax outlay, there was a tax due, right, on the bonus, then it may not be that attractive of a plan as if it was grossed up. So therefore, our total bonus for 20,000 of premium is 29,000. So we can cover the 9,400 of tax due at 34% in there. And of course, we could always just say, okay, we've got a total budget of 20,000. And then we're going to net after the gross bonus into the life policy. Maybe that number is 13,000, 14,000 a year into the policy. So either way, we're trying to go for a zero net outlay column. And if we have zero net outlay to the key employee, they've got death benefit protection. Again, based on a design, this is, I think we're starting with a $500,000 death benefit. And we're moderately funding this. And we're just doing an increase. So we have an increasing death benefit for that need. And along the way, we have just over 700,000 hypothetically in the 20th year. Again, zero outlay, a little over 700,000 of cash surrender value makes it a pretty attractive model. And the employee owns it, right? In there and so forth. So they can touch it. It's not tangible, but they can at least touch it a little bit in there. And then if they wanted to add a little more control, they could always do a restricted bonus arrangement with it and add a vesting schedule. So I have that same exact design, and we have a 10% vesting schedule where we're just vesting at 10%. You can see in this third to the last column over here on the right side, we're vesting at 10% per year. And by the 10th year, we are 100% vested in the cash surrender value. And we have a modification of ownership form at Symetra, where that is simply filled out. And that simply just states that there's a modification on the ownership of the form to our service folks. And therefore, the employee, the only thing they can really do is change the beneficiary, right, on the death benefit. And then everything else needs permission from the employer to make any other changes that are out there. So you have that control aspect. And then, of course, you got to make something attractive. You can't do a restricted bonus arrangement and have a restriction for 20 years in the plan, because it's probably not going to be that attractive. Usually what we see is like 5 to 10 years, somewhere in between there, for some kind of a schedule. 20% over 5 years period, or 10% over 10 years, however you want to do it, just something that looks attractive. So split dollar arrangements, we see a lot of those, discussions on a lot of those, flexibility in the ownership. And then, of course, if we want less complex with that individual ownership, we see a lot in the bonus arrangement space to do that. That's what we're seeing here at Symetra. So why am I talking about this? Well, with these individually owned plans, we can introduce what we have here is our Multilife business program, which is guaranteed issue underwriting. And if we have 10 or more employees in this on a, with a particular business here, if we have 10 or more employees, we can literally do a guaranteed issue underwriting where we have specific rates for our accumulator IUL product that's out there. And we can have individual ownership. We can have trust ownership. They can all be owned by the employer. They can all be owned individually. That's the beauty of it. So usually with guaranteed issue, you're kind of, mostly it's the employer in that COLI space, if you will, the employer ownership. And maybe you need 15 or more lives in there, but we're flexible on ownership and a minimum of 10 lives to do this. And don't worry about getting caught up too much in the weeds. Just kind of get the headlines, because Stephen and I are here to help you if you have a case, and work through it and make sure it's a good fit in there. So, our just high level, our issue ages are 20 to 70. So we can't take anybody over age 70 with our reinsurance arrangements in there. And our minimum income, along with a good job description, you can see we're looking for executives, owners, management in there. I would even put like professionals and white collar positions. Think of your technology company with coders, programmers that are key. We've seen cases like that. They're not necessarily, executives or management, but they're highly compensated and they're key individuals that are out there. And we only require a minimum income of 75,000, and we include bonus plus salary to get to the 75,000. So theoretically, if you had key individual with a good job description and a good fit for our program, then if they were at a salary of 70,000 and you were doing a bonus of 10,000, we would count that as 80,000 for the total compensation package that's in there to do that. So ages, income, all that stuff, I think we're pretty flexible with it to do that. So it is guaranteed issue. We are looking for full-time employees that are working a minimum of 30 hours a week. And this is all the 3 questions that are on the app, which I'll touch on a little bit more as I go along. And of course, there's always some exclusions. I'm not going to spend a lot of time on them, because I think you really just ask yourself, do we have an employer-employee relationship? As long as we have an employer-employee relationship, then we have a case to talk about out there. If it's people that are members of an organization and so forth, then it's a tough conversation, but we can talk about it and see if it is a fit. I had mentioned it's our Accumulator Ascent product that's currently on the platform. Look in the future for enhancements. We may add some other products, some term and protection IUL as we get going along. And again, a couple other little tidbits. We're looking for an average age of 55 or younger, but again, we'll help you with all that in there. We do have the two rate classes in there. You're either a smoker or non-smoker, and they're multi-life rates. That's it with the accumulation, which again, I want to add is the accumulation accumulator, IUL product, retail, everything still the same, like compensation, everything is still the same. There's no little tricks there. It's just the same product. We will accept 1035 exchanges, kind of neat. And we can do a foreign national. We can do 10% of a group as a high net worth foreign national that fits within our national foreign national program. It's in there. And we will, we don't have any issues if it's going to be premium financed. We just look at a traditional premium financing scenario with the business as the borrower. And we, instead of the individuals, we just look at the financials in that review process for the premium financing as those of the financials of the business as the borrower in there. So not much different from our traditional premium financing program. It's just the business financials to do that in there. And so as far as our limits go, our multipliers, pretty attractive multipliers and pretty straightforward. We get up to 19 lives. We can do 50,000 times the number of lives. And then if we get 50 or plus lives, then we can do 75,000 times the number of lives. But, just high level again, maximum face amounts 5 million. And if you have multiples that exceed 5 million, we have to stick to 5 million, which is still pretty good for guaranteed issue that's out there. And we do have a cap of 20 times salary, but I've never ever seen an issue or a cap with it. Next case comes in tomorrow. I'm sure I'll have that issue and I'll laugh about that. But anyway, you see what the multiples are. They're pretty straightforward. Again, we can help you with that in there. And again, there's only 3 questions on the application, and you can see the 3 questions right here that are on here. Have you ever been hospitalized or absent due to work or illness for more than a total of 3 days in the last 3 months? Yes, you all know that was written by a legal team, that particular question. And of course, are you actively engaged full-time at work, and are you a tobacco user or not? That's it for the app. So if somebody answers yes, have you been hospitalized or absent from work in number 1, we just need to know what it is. Could have been the flu, could have been a broken arm, could have been a broken leg, little, you missed work for a little bit. And then we run it past the underwriter. And if it's minor or not a big deal, we're right back in with the guarantee issue group that's out there to do that in there. So the app is very short. Process is pretty unique also in the fact that all we really need is a full census from you. When I say full, we have a sample census that's fillable, where we need certain information so we can do our internal review. And we have a submission form, which is basically, it helps you just create a cover letter for the actual information on the case and so forth, and then some financials on top of it to do that. So once we have that in-house, we do our review, we turn it around fairly quick. And then once it's approved, we create an offer letter. Once you have that offer letter in your hand, you are free to submit business. And of course, you'll be connected with, Stephen, if you have a case, and Leah, excuse me, if you have a case. And we will also get you connected with the new business team to make sure you know just right where that case is going to go for processing. So pretty easy, pretty straightforward. We can turn these cases around pretty quick that are out there. And if I can just suggest that I'm using, executive bonus, split dollar as the example, but I want you to think, take the whole business arena that's out there and all your key person coverage. When you start thinking of law firms and they need partnership coverage for their buyouts, so you have senior partners, junior partners, you have so key person coverage there, or even buy-sell coverage there. Think of your regional hospitals that are either profit or nonprofit, where they're trying to keep those medical professionals. Could be medical staff, it could be executive staff, trying to keep those. Loan regime split dollar comes up all the time as a great tool to help reward and retain in that space to do that. And then, of course, if you're talking about multi-life, it opens up the window. If you're talking to a business owner, you could be all of a sudden talking about buy-sell planning. You could be talking about wealth transfer planning. We're talking about estate equalization. Everything comes out of a multi-life conversation that's out there. So anyway, I'm going to pause and see where we're at, Kathy.
Doug, thank you. That was terrific. I've got a couple questions. A couple questions came in through the Q&A, and if anybody else has any questions, please type them in. So number one, are there any states where this is not available?
Geez, off the top of my head, and maybe Stephen can help me with this. Is it
Well,
California?
yeah, only New York, right? I mean, the AIUL contract is available in all the other states other than New York. The multi-life program is just the package, so that's allowed everywhere, but it's just the AIUL is not in New York.
There you go.
There you go. Thank you. You mentioned the three questions, and the first question was if you've been absent for 3 days, or it was, if you could go back. Yeah. There you go. And you said, number one is really not an issue, as long as we get an explanation and we're fine with the explanation. But then the note right under question number 3 says, if the applicant answers yes to question 1, they are not eligible. So it's really,
yeah, I mean, that's, yeah.
So
yeah, I mean, yeah, that's the point I'm trying to make, is that, if somebody really has an illness, and they're in the, obviously we're a life insurance company, we're trying to minimize risk in the guaranteed issue pool, right?
Right.
So that's a truthful question in there. And if somebody does say yes to it, then again, we have the ability to work with the underwriter depending on what it is.
So we just need an explanation.
Yeah.
Gotcha. Okay. I just wanted to point that out. Okay. So some of the questions that came in, Matt Schiff has asked 2 of them. What is the ratio of NAR per life on the GI?
Well, so that would be a Matt Schiff question. Yeah. And hi, Matt. I mean, I don't think I can really answer the question for you, Matt, because it really depends on the group. And I can tell you that we definitely don't want a net amount at risk to probably go beyond $10 million, which it's really not gonna, because even if we have a max funded plan, we're minimizing the net at risk. And even if we have a initial face amount within our multiples, are we actually gonna exceed whatever that face amount is for the net amount at risk? And so forth. So that's kind of my high level answer to you, Matt. And we can certainly talk about it some more on the side.
Fair enough. And another question, it was really a comment from Matt. He says, if the plan is expecting to forgive the loan, then a 409A DOL notification must be filed. I don't know if he was, I guess he was asking you to comment on that.
Yes, and I did comment on that at the beginning. I did say it was hypothetical, the split dollar arrangement. We're just assuming that the plan where the employer may forgive the outstanding loan. And as Matt is suggesting, that at day one, if the employer is saying we're going to forgive this loan, then yes, you have a 409 arrangement and you have a promise to pay a future benefit, and you typically have a deferred compensation arrangement. And you'd have to abide by the 409A rules if that was the intent.
Terrific. We've got another question that just came in from Mr. Pointer. Can you show a census that we would need to submit? If not, could you email us one? So
absolutely, yeah. We have billable census. Yeah.
Okay, so we will email a sample census afterwards, and then maybe what you could do on your presentation is attach it so that when we go to post this on our website, the census is also there with the
we'll also attach the submission form, which is another submission tool. Yeah.
Perfect. Great. I had a conversation with someone the other day about how to retain top attorneys that perhaps were exiting firms to go be hired en masse by other firms. And it's certainly through executive benefits, some sort of retention plan. And most, it's a great conversation tool with senior partners that are worried about losing their talent pool that they have trained since or recruited since graduating from law school. And then you have attorneys that are leaving en masse to go someplace else. So just as a FYI, something to discuss, especially with law firms that you may be doing business with.
Yep, absolutely.
You know, one last point.
I am getting some feedback on that. Were you able to hear that, Doug?
I didn't hear it, no. Stephen, can you try it again or no?
Okay, am I in now or no?
Yep.
Now you're good.
Better? Okay.
Yeah.
So I was going to say is all the cases that Doug mentioned, those types of cases are all cases that we actually have on the books. And to your point, the largest one we've done so far has been a law firm for exactly that reason. So you're 100% correct in terms of what we've seen.
Terrific. So don't let somebody else be talking about this with the law firms that you're dealing with. Make sure that you're the first one in the door. I don't think, here we've got another question. What is the process of adding new key people to this program? Assume as long as we met the total employee number, I would assume at inception.
Yeah, so we, our platform is really set up for on we'll call policy anniversary. We can add new participants in there, and that's all structured so we keep the list bill the same, right? So we want the list bill to go to the employer is paying the premiums in there. And so, you know, they're 60 days out from policy anniversary. If there are new lives to add, that's when we engage in the conversation and we do our quick review and get them added to the plan. If somebody wants to do something other than annual, come and talk to us and we will do our best to make it work. In other words, if somebody wants to do something quarterly or semi or just, you get it, right? Like in a law firm, partners get or attorneys get promoted to partner, and perhaps waiting till the anniversary isn't a big deal. But if they want to do something sooner, then come and talk to us.
Terrific. I don't think that we have any other questions. Doug, this was terrific. It's a wonderful opportunity. And we look forward to working with the advisors and hopefully submitting some business to you in this platform.
We look forward to working with everybody. Yeah.
Thank you. Stephen, is there anything else you want to add before I turn this over to Lisa Mitchell?
No, just thanks again for the opportunity, guys. Really appreciate it.
Okay. Lisa has some important announcements as to what's next on the Agency One webinar calendars. So Lisa, you're muted.
How about that?
Perfect.
Am I good? Thanks.
Yes.
We've got 2 more webinars for June, and hopefully we'll see all of you on these webinars. The next one is on June 24th, and it is nationwide, and the title is Why Affluent Clients Need LTC and How to Internally Split a 1035 Exchange for Better Purposes. Speaker is going to be Sean Britt. So that'll be a great one. We'll have another copy of, you'll have another opportunity to register a little bit later this week for that if you haven't already. The next one is June 26th. and it's entitled Unlocking Everyday Efficiency, How to Use AI for Marketing, Communication, and More. And the speaker for that one is Rick Buteau, who you'll remember if you were at our annual meeting. Rick Buteau moderated our pre-conference session, which was very popular on AI. So he'll be with us again on June 26th. So I look forward to hearing that, and hopefully all of you will be able to register for that. We'll have a few more for July, but we'll intro those as we get later into June. So that's all I've got for now. Thanks a lot, and thanks everybody for attending.
Thank
All
you.
right, thank you, Lisa. So Doug, Steve, thank you. Thank you for everybody that dialed in. We know that you have choices. Agency One is privileged to be able to do business with you. If you have any questions, comments, concerns, cases you'd like to discuss, please reach out to me, Gonzalo, Dennis, or anyone on your Agency One team. I hope that you have a great weekend, and we'll be seeing you soon. Take care. Thank you. Bye-bye.